we are done for chapter 4. Let's proceed to chapter 5, capital budgeting. So what is capital budgeting? It is the one who manage to control the business owner funds, maximizing earnings power. So what is maximizing earnings power? Maximizing earnings power is about making smart choices to help a business na makamake of more money. Example, think of a lemonade stand. Ang buhaton sa maximizing earnings power would mean using fresh ingredients kay para mas daghan pa mopalit sa imong lemonade. Kay kung dili na fresh, kisa pa may mopalit, makahatag kag sakit sa ilang tiyan baron kay dili naman fresh imong giserve sa imong customers. Offer pa jud ka great customer service para mas maganahan sila mopalit. Or muad ba karon og flavor or imo ibaligya kundi i-endorse sa online kay para mas daghan maingganyo or mopalit ba. What is capital expenditure? Budgeting for capital expenditures is a crucial executive function requiring management to effectively manage these funds. So what is capital expenditures? So what is capital expenditure? In other words, CAPEX. Capital expenditure or CAPEX is when a company spends money on things like buying, upgrading, or maintaining long-lasting assets, such as equipment or buildings. These investments are made to benefit the company in the long run, either by generating more income or improving how it operates. It's different from everyday expenses. Example, imagine a bakery deciding to buy a new oven. This investment is expected to last a long time and will help the bakery produce more cakes, increasing overall revenue. This chapter discusses capital budgeting, a crucial aspect of business finance, including concepts like investment, valuation, risk, and uncertainty. Basic terms in capital budgeting provides a comprehensive explanation of capital budgeting concepts like capital expenditures, capital budgeting, valuation, and investment. So for capital expenditure, as what I have explained earlier, capital expenditure or CAPEX is like spending your money on things like buying, upgrading, or maintaining long-lasting assets. And to explain further about this capital budgeting, capital budgeting involves planning to determine if long-term capital investments like machinery, plants, and research projects are worth funding through debt, equity, or retained earnings. It aims to increase shareholder value and is crucial for strategic financial management, especially an investment. Think of a company deciding whether to build a new factory. They would look at how much it costs to construct the factory and buy the machines. The machines is the capital expenditure. Then they estimate how many toys they can produce and sell over the years, considering the increased capacity. If the future toy sales bring in more money than they spend, it's a good capital budgeting decision to build the new factory. That's all, thank you.
Now we proceed to objectives of capital budgeting. Number 1. Establishing priorities. It seeks to facilitate the directors of a given entity in taking preference over specific details over others within a specified period. Next, the cash planning. It is the process of creating a detailed budget and financial plan to manage income, expenses, and savings. Now we proceed to construct planning. It essentially covers the choosing of relevant policies, procedures, and processes to achieve your project goals. Next, we proceed to elimination, duplication, and receiving plans. It is the process of merging the data associated with two or more identical objects. Now we proceed to the capital budgeting system. First, preparation and submission of budget requests means it is a spending plan based on income and expenses. Next, approval budget. Approval budget, a work of program or a budget that has been approved by the management committee. Next, the request for appropriation. It is an eternal request from a company division to the company's management board, or treasury department. Next, we have a submission of progress and post-approval reviews. It is the purpose is to enhance the protection of human subjects and the oversight of approved research.
Evaluation of proposed capital expenditures. Proposed capital expenditures should be scrutinized since they involve large outlays of funds. A number of primary factors should be considered by management. Certainly, when scrutinizing proposed capital expenditures involving large outlays of funds, management should consider several primary factors. So there are several primary factors, which is return on investment, second, risk assessment, third, strategic alignment, cost-benefit analysis, alternative options, long-term impacts. Truly considering these factors, management can make informed decisions regarding capital expenditures, mitigating risk and maximizing the potential benefits to the organizations. Methods of economic evaluation. The firm's primary objectives is profit, and all business activities should focus on the achieving this end capital investment. Therefore, investment proposals must be analyzed and their economic value determined. The payback method, average rate of return method, and discounted cash flow methods are three fundamental evaluation methods used in exhibit. Firm's primary objective is a profit, and it underscores the need for all business activities, especially capital investment, to align with this objective to assess investment proposals. The statement mentions, so there are three fundamental evaluation methods: payback methods, average rate of return methods, and discounted cash flow methods. By employing these evaluation methods, business can analyze investment proposal rigorously, considering both short-term and long-term financial implications to ensure they contribute to the firm's overall profitability.
Today I am discussing about risk, uncertainty, and sensitivity. The uncertainty is expected return in capital expenditure evaluation challenge. Financial managers' returns are never fully certain, and the assumption of certainty in economic evaluation methods is misleading. Whereas uncertainty and sensitivity are related concepts referring to variation in the actual expected values caused by errors and estimate. Both terms are similar but differ in their meaning and impact and outcomes. In summary, risk deals with non-probabilities of adverse events, and uncertainty deals with situations where probabilities are hard to ascertain, and sensitivity analysis help assess how changes and variables impact decision outcomes or models. Example: imagine a company that manufactures and sells umbrellas. They are considering whether to invest in a new automotive manufacturing process to increase production efficiency. So, what means the automotive? Automotive means equipment. Manufacturing means create. Now we proceed to chapter 5, which is working capital, how it works capital. So now, working capital defines generate revenue by offering product or services to customers, requiring total capital for day-to-day operations, and working capital for funding. So in short, working capital is calculated as a current asset minus current liabilities. So, for example, if a company has 100,000 and 50,000 in accounts receivable and 30,000 in inventory and 20,000 in accounts payable and 10,000 in a short-term loans, its working capital will be 150,000. So how it works? Now, 100,000 ako siya gi-plus sa 50,000 may cost siya sa 150. So i-plus mo dyan ako si 30 sa inventory, 30,000 may cost siya 180. So ako siya i-minus sa iyahang account nga 20,000. So it will be 160. So ako mo siya i-minus sa iyahang 10,000 sa short-term loan. So minus sa 10,000 sa short-term loan, may cost siya of 150,000. So mao na siya ang iyahang capital sa working capital. So mao na siya on how it works working capital. Working capital is the part of company's capital that continuously circulates, converting initial cash funds into inventories, which are then converted back into cash. Gross working capital is the total amount of a firm's current assets, including cash, checks, bank balance, marketable, security notes, accounts, receivables, suppliers, inventories, and expenses, and deferred items, which are typically the firm's current liability. The remaining composition of working capital is calculated as the difference between a company's current assets like cash, accounts receivable, and inventory. For example, so sa example na siya duha si positive working capital o si negative working capital. So kinsa man si positive working capital? Si positive working capital indicates the company can over-in short-term obligations. Si negative working capital suggests potential liquidity issues. For example, ni positive working capital. If company has 500,000 in current asset, cash, receivables, and inventory, and 300,000 in current liabilities, payables, short-term debt, and has positive working capital of 200,000. So how? Current asset is 500,000, di ba? Ang current liabilities niya is ang 300,000. So, di-minus na siya, mo equal siya o 200,000 ihang working capital sa positive working capital. So next, sa example sa negative working capital. So, sa negative working capital, if a business has 200,000 in current asset and 250 in current liabilities, it has negative working capital of 50,000, indicating potential challenge in meeting short-term obligations. So how? Business has 200,000 and current asset have 250,000. So, imo na siya i-minus. So, the total of negative working capital is the 50,000. Now, we proceed the need for working capital. First, the firm's sales target requires an sufficient inventory, which depends on the firm's available resources. Second, operating expenses require a working capital to cover salaries, wages, advertising, taxes, license, insurance, premiums, and interest payment to maintain the firm's daily operations. Number 3, credit sales of support may require sufficient working capital to maintain operation until receivables are converted into cash. Next are the firms should have sufficient capital to cover unexpected expenses, cash inflow delays, and potential revenue decline. So, muna dyan ang mga need sa working capital.
Management of working capital. Management capital must meet company fund requirements, but unusual pressure on working capital can make finance management difficult despite achieving objective. What is working capital management? Working capital management requires monitoring a company's assets and liabilities to maintain sufficient cash flow to meet its short-term operating costs and short-term debt obligations. It refers to the management of a company's short-term assets and liabilities to ensure that it has enough liquidity to meet its operational needs. The goal of working capital management is to optimize the balance between the company's current assets, such as cash, accounts receivable, and inventory, and its current liabilities, such as accounts payable and short-term debt. An example of working capital management is computing the accounts receivable turnover ratio and decomputing the day sales in receivables. Another example is analyzing the change in the working capital ratio from one year to the next. Overall, working capital management focuses on managing the company's current assets and liabilities efficiently to ensure that it has enough working capital to support its day-to-day operations. By doing so, A company can minimize its financing costs, improve its cash flow, and enhance its overall financial performance.
Liquidity management. Liquidity management is the process of a firm ensuring it can meet its obligation and pay its bill on time. So, liquidity management is ano siya ang process para ma-ensure na ma-meet niya ang iyang obligation na makabayad on time. What is liquidity management? So, when we say liquidity management, it involves monitoring and controlling a company's cash and assets to ensure it can meet its short-term obligations. Liquidity management helps maintain financial stability and supports day-to-day operations. Strategies include cash flow forecasting, optimizing working capital, and having access to credit facilities. In liquidity management is siya cash sales percentage, collection of accounts receivable, loans, sales of asset, ownership's contribution, advance from customers.
Cash management. Cash management involves balancing the need for investment and maintaining sufficient cash to cover a firm's cash expenditures. Cash management refers to handling, collecting, managing, and investing cash. There are 5 major of cash approaches included in cash management. Money mobilization techniques, improving cash flow, forecasting, defining liquidity reserves needs, developing alternative source of liquidity, and aggressively searching for product uses for surplus money assets. If we say cash management, mura na siya, lihok na siya sa usa ka kumpanya or a business na naa dito involved ang collecting or lihok or circle sa lihok sa usa ka kwarta ba sa diha sa usa ka company or business. Cash management includes many areas of finance, assessing investments, cash flows, and market liquidity. Effectively, cash management involves much more than simple avoiding insolvency. The last one is account receivable management. Account receivable management is crucial for a firm's financial viability, as improper management can lead to impaired sales. The goal of business finance is to maximize profitability, and credit extension to clients aim to achieve this. However, increased sales may be offset by bad debt losses and tied-up funds in receivables. The objective is to determine the cost of profitability of credit, sales projections of cash flows, and direction and controls of credit extension activities. So, if we say account receivable management, his example is sa lending, sa kurente, sa kumpanya sa kurente is mag-offer na sila kurente sa bago pang tukod na kuan baron pamilya, yan na. Nag-offer sila, nagkuha sila kurente. Ang kanang client, kanang nagkuha ng kurente is makakuha na dayon sila sa kurente, makagamit, pero dili, mura galay kuan credit ang pagkuan ba paggamit sa kanang bayad kana. So bali nagagamit na ang kanang client sa kanang serbisyo sa kuryente, pero dili pa nila na whole pay ba na bayad nila, wala nila na humanog ay wala pa nila na fully paid ang ilang bayad sa kuryente. Yan, ibutan na nila sila sa nana sila account or account receivable nila ilista dito ang ilang mga client na dili pa paid sa ilang receivable management. The process of monitoring and controlling money customers owe to a business for goods or services. Ito kung dito kanina. Purchases on credit. Account receivable management consists of policies and procedures that maximize account management efficiency and maximize the risks of bad debt.
That's it. I hope you learned something. Maraming salamat po.